right, today's topic, I'm sure you're seeing a lot of marketing, commercials, advertisements from different tax firms that are trying to convince you to do your taxes on your own and that you are smart enough to do it. So one of the questions we get a lot from people is, when do I need to speak with a tax professional? So in today's video, I'm going to go over 5 different times that it's worth talking to a professional. Number 1, probably one of the most common areas, also one of the more complex and confusing areas, is when you start investing in real estate. Whether you're investing in a rental, a flip, maybe you have an Airbnb property, each of these different scenarios have a different set of rules for how they're taxed. One item in particular that comes with investing in real estate is depreciation. Depreciation is very complex and can either benefit you greatly or end up costing you a lot of money when you sell the property. Number 2, similar to real estate, is maybe you bought a house for yourself, but it's a duplex. Maybe it's a triplex. We're seeing more and more individuals invest in a multifamily property where they actually live in the property and then rent out the other units to help pay for the cost of the mortgage. It's a great strategy, but you are now a real estate investor. And so the units that are being rented out need to be treated as a rental. They need to go on a new schedule within your tax return, and depreciation needs to be accounted for. Number 3, starting your own business. Either you began your own business or maybe you just switched from being a salaried employee to self-employed. The deductions and expenses that you can use when you're a business owner are far different than when you're a salaried employee. So what you can or can't deduct could impact your bottom line quite a bit in the coming years. Number 4, creating an entity. So maybe it's for your business, maybe it's for an investment. If you set up an LLC, it could be taxed as a sole proprietor, a partnership, an S corporation, or a C corporation. In fact, if you do have it set up so that it's taxed as a corporation or a partnership, there's a whole different tax return that needs to be completed. And then finally, number 5, I just touched on it a little bit, but having a partnership. Maybe you invested in a piece of property with a friend, or maybe you started a business or invested into a partnership. Anytime you have a partnership, there's a separate tax return called the 1065 that needs to be filed. Not only is there a separate tax return, but the due date is March 15th, not April 15th, like your regular personal tax return. And so for every month that return is not filed, there's a late fee and penalties per partner. So you can see if there's 5 or 10 partners a month, a couple $100 penalty per partner for every single month, that could add up quick and cost you a lot of money. So those are 5 areas: real estate, investing in or living in a multifamily property, starting a business, creating an entity, or being involved in a partnership. All those, I highly recommend speaking with a tax professional.